Hi guys, welcome back to Bazaar Corporate Radar. This festive season, the markets are also obliging. At least this morning, the Nifty is up about 0.5% and the Sensex is up more than 200 points. But joining us now is a long-time India watcher and a veteran of the markets, Prashant Kothari, the Senior Investment Manager at Pictet AMC is with us. Prashant joined Pictet AMC in 2012, before which he had spent, I think, 9 years at ICICI Prudential AMC. At Pictet, Prashant manages more than 250 million euros, and some of his largest holdings include the HDFC Twins, Infosys, Bharat Financial, ITC and Power Grid, amongst others. Hi Prashant, thank you for taking the time out and speaking to CNBC TV 18. Happy Diwali to you and your team, by the way. This is a very different Diwali from the one we celebrated last year. I mean, emerging markets are down 15% this year. Sentiment has been punctured completely and portfolios are bleeding. Do you think the worst is over?
The top-down picture has certainly deteriorated over the last 1 year because we have had higher oil prices, which has led to higher current account deficits and therefore pressure on currency, pressure on rates, and which is leading to the stock market correction. And therefore, yes, the current time is certainly tougher than what it was last Diwali. But with tougher times, we're also seeing that the equity prices are actually lower, and which for long-term investors should actually be a good news, that last year Diwali was probably a time for euphoria, while this year is the time when euphoria has subsided down, and therefore the stock prices are looking much more interesting for long-term investors to put money to work.
Okay, Prashant, good morning. Thank you very much for joining us ahead of the festive season. What is the feedback you are getting from, foreign portfolio investors? Has India moved lower in the pecking order for emerging market investors after this, all these issues of debt and stuff like that over the past few months?
So the long-term prospects of India, I don't think have changed materially. So investors who invest into India for the next 5, 10, 20 years, I think they are still very much encouraged by the progress India is making. And today only we have seen how World Bank has improved the ease of doing business rankings for India. But from a rank of 100, now it has come to 77. And I think these are the signals that the long-term investors look out for. Also, we are seeing what is happening in China, where the Chinese economic model is under pressure because of the tariff issues with US. And this is also actually resulting into more favorable kind of kind of a outlook for people investing into India. We are definitely seeing that the foreign investors are taking out money from India, but I think as the dust settles down and as and when crude oil cools off, you will see the same investors returning into the market again.
Prashant, hi, good morning. How are you tactically positioned in the Indian market then, and where do you see it headed over the next 12 to 18 months?
It is always tricky to predict where the market will be in the next 6, 12, 18 months time frame. Having said that, we understand that there are these macro risks on the horizon. We understand that the oil prices are high, which is not a great news, which would probably lead to some tempering of consumption in India, which has been on a very solid footing in the last few years. So we are a bit cautious about consumption stories out there, more on the discretionary consumption side. We are also bit defensive also because we see that the election scenarios are probably not being factored in properly by the market, and there are scenarios which can be good, but there are scenarios which can be bad as well. It's very difficult to predict as of now what will happen next year, but we believe that all the probabilities are not factored in properly by the market. So it probably makes sense to be defensive as of now, but also see the opportunities on a bottom-up basis. Wherever stock prices start looking interesting, we are happy to build our positions into them, ignoring these near-term uncertainties.
Okay, so do you see a global liquidity tightness situation continue on account of the US Fed tightening? I mean, you just mentioned that. What's your assessment of when liquidity pressures abate and flows start to pick up again?
Global liquidity has definitely become tighter because of the US Fed tightening, but we have to keep in mind that US Fed has been tightening for about 2 years now, and therefore maybe sometime next year they will actually stop tightening, and the liquidity could start flowing in again. So maybe we are about 6-9 months early in that assessment, but maybe mid 2019 is when you will start seeing that liquidity pressures are not as much as they seem as of now, and which will be which will probably lead to weakness in US dollar and therefore stronger EM currencies as a whole, and which will be a good news for Asian markets, including Indian markets, as we move towards mid 19 kind of a time frame.
Prashant, you are cautious on consumption, as you said, but what about capital goods? Larsen & Toubro's earnings looked very good. They're probably indicating some kind of a pickup in capex. Are you seeing green shoots, and would you be an investor in this sector?
So the capex cycle in India has been very bad for a very long period of time, and this has been result of overinvestment in the past cycle, which is getting corrected now as the Indian economy is growing, more and more consumption is happening, and therefore you are seeing that the capacity utilizations have actually picked up, and which should then result into a better capex cycle for the next few years. These results are probably showing to us that there are some green shoots out there. We also need to keep in mind that the capex has so far been driven by the government's balance sheet, while not much of private capex has happened so far, and the government balance sheet is getting constrained because of the fiscal deficit issues, and therefore probably will not get much of support from that side of things, and it's the private capex which needs to pick up. For that to happen, we need better investor sentiment, more confidence in terms of how things are progressing, and maybe after we are through this hump of the election next year, you will see that private capex also picking up when corporates are much more confident about the regime for the next 5 years.
Your view on corporate banks, especially PSU banks, because they have destroyed a lot of wealth over the last 3 years, always have disappointed. But do you reckon a bit of a bottom could be in place?
The worst is probably over for these banks that you mentioned, but yeah, we have heard the same kind of a story for the last few years, and somehow or the other, the banks kind of fall into some of the trouble. So yes, maybe we'll be sure of it only in the hindsight. The other thing to keep in mind is how are we defining these corporate banks, because every bank that we meet is actually talking about moving more towards the retail and SME side of the business rather than expanding their corporate banking franchise. So I don't think there are any corporate banks left which are really saying that yes, corporate business is where we really want to grow our business. Essentially all the banks worth their salt have become more and more of a retail banking franchise, or if they are not already, they are trying to move towards that, because over the last 10-20 years we have seen that that's retail-oriented franchises which are actually able to create much better profitability and therefore value for the investors, and this is what the managements are also coming to realize, which is probably leaving this hole out there in terms of who will really fund this corporate capex if this were to pick up.
Okay, so you said that the worst for the corporate banks perhaps is over, but what stage of the market cycle are we in? Even if this is just a bull market correction, do you think we've reached a mature stage of this bull market?
Maybe I should take you back to 2013 year. So essentially 2018 is kind of panning out very similarly to what happened in 2013, which is when oil prices went to like $100 plus. India again had a huge current account deficit. There are all these macro concerns, and the election was like an year away. I think we have a very similar setup now in 2018, where we again have high oil prices, high current account deficit, and there are all these top-down concerns, and the election is about a year away. And the stock prices have actually come off like they did in 2013. So I would say that if you are more longer-term focused, then we have to just find the right stock. Right stocks which are trading at reasonable valuations, and as long as we are able to find that, these are good times for us to kind of fish in these waters. This is not easy. Stock picking is never meant to be easy out there, but I think for experienced investors, these are really interesting times, because while the overall market has probably only corrected 10-15%, there are several stocks which have come off like 30, 40, 50%, and these are becoming real value ideas out there.
You're actually saying this is a 2013 kind of scenario? Then it should be a very great time to buy stocks, isn't it? And if you are buying now, what would you look at in terms of sectors?
I think the financial stocks have corrected meaningfully also because of this crisis of confidence that we are seeing after the IL&F's fiasco. So those stocks are very interesting to us in terms of their valuations. These are multi-year compounding stories out there which are now trading at much more reasonable valuations than what they were like few months back. So that's probably the most interesting part of the market today.
Okay, by the way, don't lose sight of the market. The mid-cap index is now in the red and a couple of stocks. Indigo is trading at the low point of the day. I think Jet Airways is also almost following that. That is the problem with some of these aviation stocks at higher level. There is some selling pressure which comes in. Look at Indigo is now making lows of the day. I think Jet has shown almost similar chart, down about almost 3%. Prashant, in that case, what's your specific view on the liquidity in the NBFC space and has it spooked foreign investors?
I think time and again what we have seen, not just in financial sector but also in other sectors, that whenever such crisis happens, it's the stronger companies which come out even stronger, while the weaker ones kind of just vanish away or disappear from the scene. And which is what our prognosis is even for this cycle, that yes, liquidity will have some accidents and there will be some companies which will disappear, but the stronger ones will probably become even stronger. And these are the names that we are focused upon because even their stock prices have come off. And as and when this dust settles, you'll see these companies growing much better with even greater market shares and enjoying durable profitability. We are really focused upon entities which have really good reputation, both in terms of how they manage their business, and what's their reputation in terms of financing of the business. And these are entities, I mean, AAA is a bad name today, but yeah, I mean, these are real AAA entities out there where they've enjoyed good reputation over several decades and therefore should come out even stronger after this crisis is over. I don't think anybody is disputing that this crisis won't be over. It's just a matter of time, whether it takes 1 month, 3 months, or 6 months, but it will be over for sure. And after that happens, you will see that these stocks are actually doing much better than what they have done in the last few months.
Prashant Kothari, it's a pleasure speaking with you, and thank you very much for ending on that high note, that exactly this is the fearful time when you should look at who will survive this crisis and pick them up. And for what it is worth, with Prashant's words, some NBFCs are quite clearly in the green.
Oh, yes, there are. But, you know, Indiabulls housing has started to fall from the high point. A couple of others as well. The market is quite okay. We have Ashwini Gujral, Mitesh Thakkar back with us. Rajat Bose is also joining us. Good morning again. Ashwini, you've been recommending long trade for the next for few hours. What would be the call on the index? What would be the stop loss on that long trade, and what are the individual stock calls now?
See, the whole idea of the long trade is that how strongly can the market correct? And if we see the evidence from yesterday and today shows that there isn't big selling happening at 25,900, 26,000. Neither is there big selling happening around 10,650, 700. So that means that at some point the market will consolidate and take these levels out. So each of these dips from the highs that you get are buying opportunities, and even on PSU banks, which is kind of letting off some steam, I think even there you should buy. I think by the time this week is over, the consolidation is over. This week was expected to consolidate. We've hung on to the higher end of that range. So you will come out on the upside. Having said that, I think FMCG, consumption type names are doing well. So Titan is a buy with a stop of 865, target of 890. Jubilant Food is a buy with a stop of 1060, target of 1100. And Bata is a buy with a stop of 1,000, target of 1,045.
Okay, well, this market is in a mood to punish a lot of the weak numbers. I mean, look at Balkrishna Industries, 10% knockdown there post the margin disappointment that the company has thrown up, and huge volumes on Balkrishna Industries as well. Of course, it has Cipla for company. That one too now is at the low point, down about 4% Mitesh Thakkar and Rajat Bose are also with us. Gentlemen, thanks for being with us. Mitesh, the headline index is still holding up. What would be your buy and sell calls now?
I still have buy calls, and I think I would agree with Ashwini. Buying into banks still might be a smarter strategy. Indian Bank is on my buy list. Keep a stop at 258. Look for targets of 280 here. And Eicher Motors, I think that's a buy as well. Keep a stop below 22,450. Look for targets close to about 23,300.
Okay, some first signs of IT picking up now, and for last 2 days you've seen Mindtree, for example, NIIT Tech, Hexaware. These are the kind of names where you've seen quite a bit of buying, and Nifty IT is now making highs of the day. It looked like yesterday perhaps that trade really reversed and started with Mindtree, and that's playing out. Mindtree, Hexaware, NIIT Tech, the stronger of the mid-cap IT pack is really doing well. Just look at that. Some of these stocks, they're doing quite well. Rajat Bose is also with us. Rajat, good morning. Your thoughts on index and your trades?
See, as far as the index is concerned, I think 10,700 to about 10,800 is the range up to which I'm expecting that this rally can move up to. After that, there would be some consolidation or correction or whatever that is. Having said that, I would say that now, since we are very close to that target, there would be some stocks that would actually react from levels that they were supposed to react. Like, for instance, I have chosen UPL. Which to my mind 730 to about 750. Once it lost that ground in the month of May, after that it has been a Sisyphean struggle for UPL to cross that range. So I have used a sale call out there as far as UPL is concerned, with a stop above 730.40, and target would be 716 and 712. And in today's market, Oro Pharma seems to be doing well. I would put a stop loss below 779, and 794 and 798 are the two targets. This is holding ground. The formation is like a bullish flag, so there is every possibility that this might actually turn the day for itself.
All right, gentlemen, thanks a lot for joining us. IT really is the one which is standing out now. Look at Infosys' intraday chart, and that is now percolating down to the entire sector, and mid-cap IT also doing quite well. The IT index itself is moving into the green. There's clearly some sign of rotation which is playing out.
Okay, for whatever it's worth, even PSU banks are looking pretty good actually. Andhra Bank is now up about 7%, Dena Bank is up about 9%, UCO Bank is also giving a good trade this morning, up more than 4%, so that pack is not too bad. But ahead of Diwali, Nimesh and I caught up with some top fund managers, Nilesh Shah, Navneet Munot and Manish Gunwani, to talk about the markets, the sentiment, and whether the time has come to press the buy button. Take a look.
I'm avoiding buying gold. More importantly, equities have become cheaper because they haven't given any return last Diwali. It's quite likely that this Diwali they will give better returns. So it's time to buy equity rather than gold.
Okay, so there is a Diwali sale, as they're calling it, in the equity markets. Navneet, happy Diwali to you. You were telling us before the show started that this is the best time to be buying, but sentiment has really been punctured. How do you change that?
So that's the best time to buy, right? When sentiments are not good. When sentiments are good, last year at this point in time, we were celebrating implementation of GST, of IBC, of RERA. We were celebrating, I think, the expectation of growth coming back next year, corporate profitability coming back. But because of all of these things, valuations were also high, right? So last Diwali, sentiments were better, but the valuations were high. This time, maybe some of the risks that we thought last year, whether it's from trade war, from global monetary tightening, or the high oil prices, the valuations have come down. And that's why, like Nilesh mentioned, that we are not buying gold. I'm putting more money in equities. In equity mutual fund, specifically SBI mutual fund.
Sonia, happy Diwali. Happy Diwali to all the guests as well. Just to take a point forward, Navneet, you spoke about valuations correcting a bit. But have they come to a decent, like a buy zone right now, or you still feel there is froth? Simply because the earnings have not picked up in the last 4 years. Earnings have been flat, but the valuations have reached almost 21, 22x. Still, there is a room for correction?
So there is a fallacy of average. You put a person in half in a deep freeze and half in oven and say that the average temperature is not worrisome. The same thing with the market. Whether you look at the valuations or you look at earnings growth, it's a very, very similar story. There are pockets where the valuations are high, there are pockets, and I think today those pockets have become large where valuations have become reasonable if you take a slightly longer term view.
Okay. Manish, I was just listening to your video as well, where you spoke about broad outlook for in the near term, and even you believe that it's right time to look at equities as an asset class vis-a-vis the other asset classes. Your take on equity as an asset class, within that, what is your view on the mid cap and small cap, because they are the ones who've corrected sharply?
So I think there are two ways to look at it. In terms of historical attractiveness, I think we're somewhere in between.
Okay.
So rather than take a subjective opinion, if you look at our asset allocation model or other asset allocation models in the industry, everyone is in the middle zone. So I think neither are we in 2009 or 2013 kind of bottom. I don't think we are at 2010 or 2008 kind of top as well. So we're somewhere in the middle. Of course, just to buttress what Navneet was saying, I think there's a fair amount of value, because I think what's interesting is even globally, if you see, 2011 to 17 was broadly a growth style working over value style. But I think over the last few months, we're starting to see, after a fairly long period of time, the value style come back. So if you see, the FANG stocks also have started correcting, whereas the traditional old economy stocks have started doing well globally. So I think there is a trend towards value, and I think over the last 6-7 years, a lot of the asset-based industries, companies which are close to book value, those are quite cheap right now because they haven't gone anywhere for the last 5-6 years.
Okay. Nilesh, what about you? What's your view? Because a lot of people are drawing parallels to the 2013 kind of scenario. If that is the case, then this is perhaps the best time to be buying stocks. Would you agree with that argument?
So this is the best time to buy the stock, provided we are lucky and we are sensible. We need little bit of luck in terms of oil prices. Oil prices have come down from 80 to 75 and our markets are up 4%. Small cap is up even more. So we need oil to go towards 70 and then to 60. Then this is the best time to buy. We also need to be sensible. There are state elections towards the end of the year. There is mother of all general elections in 2019 mid. Clearly market is priced in a stable government. And if we get a coalition government, then this is not the time to buy equity. But if we are going to get a stable government, then this is the time to buy the equity. So we need to be lucky little bit. We need to be sensible in voting majority.